Good morning, everyone. Today we're starting our journey into financial accounting. By the end of this session, you'll know what accounting means, the types of business organizations, the principles that guide accounting, how to prepare basic financial statements, and how to analyze transactions using the accounting equation. Let's begin. So first, what is accounting?
Sir, it's about recording money, right?
That's part of it. Accounting is the process of identifying, recording, and communicating financial information to help people make decisions. For example, imagine you run a small coffee shop. You record what you earn from sales, what you spend on coffee beans, milk, and rent. At the end of the month, those records help you know whether you made a profit or loss. So accounting is really the language of business. Businesses can be structured in different ways. Let's look at the three main forms. Sole proprietorship. One person owns the business, like a local bakery. Profits and losses belong to that single owner. Partnership. Two or more people share ownership and responsibilities. Think of a law firm or medical practice. Corporation. A separate legal entity owned by shareholders, such as Apple or Toyota. Shareholders invest money and share in profits, but aren't personally responsible for debts.
So if I start a small online store, that's a sole proprietorship?
Exactly, unless you bring in a partner or register it as a company. Now, how do we ensure that financial information is consistent and reliable? That's where GAAP, or Generally Accepted Accounting Principles, comes in. They are a set of rules and standards accountants follow. Some key principles include Revenue Recognition Principle. Record revenue when it's earned, not just when cash is received. Matching Principle. Record expenses in the same period as the revenues they helped generate. Cost Principle. Record assets at their original cost, not current market value. Full disclosure. All relevant information must be reported. Example. If a company sells goods on credit, revenue is recognized when the sale happens, even if payment arrives later. Next, let's talk about financial statements, the main reports that summarize business performance. There are four primary ones. Income statement shows profit or loss over a period. Example, if a bakery earns $10,000 in sales and spends $7,000 on expenses, profit $3,000. Owner's equity statement shows changes in the owner's investment. Balance sheet, a snapshot of assets, liabilities, and equity at a specific date. Cash flow statement shows cash inflows and outflows.
So if a business wants to know if it can pay its bills, which statement helps?
Good question. That would be the balance sheet and cash flow statement. Finally, all of accounting is built on one simple idea, the accounting equation. Assets = liabilities plus owner's equity. Assets are what the business owns, cash, buildings, inventory. Liabilities are what it owes, loans, payables. Equity is the owner's claim on the business after debts are paid. Example, let's say you start a business with $10,000 cash of your own and borrow $5,000 from the bank. Assets Yikers $15,000 cash. Liabilities Yiker $5,000 loan. Owner's equity $10,000 your investment. And yes, $15,000, $5,000 plus $10,000. So to summarize, accounting tells the story of a business through numbers. Businesses come in many forms. GAAP ensures consistency and honesty. Financial statements show performance and position. And the accounting equation keeps everything balanced.
Sir, that makes accounting sound almost logical.
It is. Once you understand the logic, the numbers start to make sense.